All right. So back to what I was saying. So again, earnings. A lot of option players like to play earnings. The reason why they like to play earnings is because there's a lot of volatility that surrounds earnings. It could be to the upside or downside, and it's going to, well, I would say 75% of the time, the volatility is massive to one side. The dangerous part about playing earnings is that it is a coin toss. What I mean by a coin toss is that when you're reading earnings and when the option trader is reading earnings, what you really want to see is you'll look at the earnings and you want to see this. You want to see the reported, or I'm sorry, you want to see the estimate and you want to see the reported being more. All right. So what this means is that the estimate is what Wall Street analysts have estimated that the company would report. So when you see 74 or 748, that's really 75 cents. You just round up, right? So that's 75 cents per share as far as earnings that Wall Street is projecting that the stock or the company is going to post. The reported number is the actual number that the company reported, right? So this should be higher than this. So we're 8% above at 0.062%, which that's a large number when you're talking billions and you're talking about trillion-dollar companies. So this is what you normally want to see on earnings. You want to see a beat. Some sites call it a surprise. A beat or a surprise is the same thing. You want to see this, and then when you look at revenue, you want to see the same thing. You want to see the estimate is what Wall Street estimated. So Wall Street estimated that this company would make 33.17 billion for the last 3 months, and the reported is about 35 billion. So the estimate was 33, reported 35. They beat for about almost 2 billion at 5.77%. So this is what you want to see. This is what option traders want to see when they're playing earnings. The reason why you want to see this is because if the stock you're trading beats its earnings, it should go up. Put a star or a circle around should, right? So this is why, if you ask me, I don't play earnings. I don't play earnings at all. When I first started trading, I played earnings all the time. Earnings season was my favorite season for the stock market because you got stocks flying up, you got stocks going down, and you can make a lot of money by being right about which direction is going. Now, the whole thing about charting, trading, options is when you do technical analysis is to help you sway the trade in your favor, right? So that's the only thing that separates investing and trading versus gambling, right? Gambling is a 50-50 crapshoot. You don't know which way it's going to work. Hopefully luck is on your side. When you trade, there's charts, there's data, there's information that you can use to swing whatever you're placing your money on in your favor, or you should be. When it comes to options, you need that even more, right? And so when it comes to earnings, you don't know if there is nothing you can do to actually get these numbers unless you work for the company, which even if you work for the company, you still can't access these numbers. That would be considered inside trading. That's a whole nother conversation that I could rant about. But unless you know these numbers, you stick. Matter of fact, even if you did know these numbers, you don't know which way the stock is going to go. This is a really good example of what's happening. So Nvidia today had earnings, one of the biggest earnings on the market, period. One of the top, this is top 3 biggest publicly traded companies in the world. Everybody is watching this earnings. Everybody is thinking it's going up. How do you know which way it's going? There's no chart that's telling you which way it's going. So what you have to do with earnings when you're playing options, well, one, don't play them, in my opinion. Because again, it's a crapshoot, it's 50-50. And even if you're right, the stock can be wrong, right? So they beat on both green. The stock right now is down. So people who were hoping that Nvidia was going to go up because of its earnings, we already knew that Nvidia is a great company. It's the hottest company on the stock market. It's been the hottest company on the stock market for about 1.5 years, 2 years. And we knew that it was going to be earnings. I specifically did not play, and everybody asked me like, well, if you knew that it was going, if you know that it's going down, because I've been saying that it was going to go down this earnings probably since the last earnings, but They're asking me why didn't I play? Because I know that the stock was going to go, that the stock had a high chance of pulling back. But again, if I'm going off probability, I still don't know because it's earnings. Well, today they had earnings and they pulled back. So a lot of people are on social media, YouTube, you name it. They're mad because they're like, wait a minute, NVIDIA beat across the board. Why did it go down? And this is where I'm going to take you into another part on how to think about these companies and how to think about options when you're picking them and what you're saying with the options that you buy. All right. For one, when I look at this chart, let me strip the chart down. For one, when I look at this, right, if I look at this earnings that was in July to this earnings that just happened today on the 20th, what do you see? You see the stock is from here to here, the stock is going on a crazy run up, right? So normally when I'm watching the stock between earnings, I'm looking, 3 to 6 months back. This is a 3-month stretch. You post earnings every 3 months. So the stock has run up significantly since the last earnings, right? So when this earnings is being posted and I see people saying, I thought NVIDIA was going to 160. I thought it was going to 180. What more do you want? The stock was at $100 and it's almost at, it's like what? It hit about 148, 149. Even if they beat, and I said this in the Discord before the earnings even post, I said, regardless of what happens, it's going down. And if you're in the, well, all of us is in the Discord pretty much, you can go and see what I said. The reason I said that is because look at how much it already ran up. So if someone said, okay, I think it should go to, I don't know, 180, how much more do you want this company to run? There's not an infinite amount of money there's a lot of money, but it's not an infinite amount of money being pressed into these companies. So when people are picking options and you're picking your strike price and you're saying that, okay, from this earnings, I'm going to play 160 call, right? And for my newer people, a call is a bet that the stock is going to go up, right? A put is a bet that the stock is going to go down. So when you're saying, okay, I'm going to bet that NVIDIA on this earnings day is going to go from the 140s up to the 160s, you're pretty much saying that a company that is $3 trillion should be worth about maybe $4.5 trillion. That's what you're saying when you're picking these strikes, right? When you pick that strike, if you hope that it actually hit that strike price, you hope that it actually lands in the 160s, you're saying that a $3 trillion company is actually worth $4.4 to $4.5 trillion, which, again, to put this in perspective, this is where you got to combine a little common sense, technical analysis, and financial analysis all together, right? This company only made $30 billion, and I said only made $30 billion in the last 3 months. It's a $3 trillion company by valuation, but when we look at revenue and earnings, they made $30 billion in 3 months. Nothing to scoff at. Don't get me wrong. $10 billion a month is crazy. But let's look at some other $3 billion companies, right? $3 trillion companies. Oh, I don't have my keyboard turned on. Which one? I need 2. I think this is 2. There we go. All right. I don't know. Amazon is what, 2-3 trillion, somewhere in that price park, right? Somewhere in that park, 2 or 3 trillion. What's the difference here? So you got NVIDIA last 3 months. This is Amazon's last earnings, right? NVIDIA made 30 billion. What is this number right here? This is 157 billion from Amazon, right? So again, you're saying that a company that only makes 30 billion in 3 months should be worth almost double a company that makes 157 billion. Again, this is where the common sense comes in, that when you're picking these strikes, that makes no sense. There's some euphoria for sure added into NVIDIA for the AI hype, but that is forward projections. NVIDIA is worth 3 trillion, not because of its revenue, but because of projected profit. But we all know, so they like to say that it's priced for perfection. That means that NVIDIA is priced to where if it continues, it has to continue to print the same numbers that it's printing right now, but for like the next 5 to 10 years. We all know that we don't have a stable market like that. We don't have like the geopolitical landscape is already on pins and needles. So if the products or the materials that NVIDIA is using to buy chips or whatever, let's say China does something to Taiwan, or let's say the Russian war escalates or whatever, that's it for the forward projection of NVIDIA. So it's too much leaning on the valuation of the company, in my opinion. So again, when it goes back to earnings and you want to play earnings and you're thinking this should go up, this should go down, the easiest thing to do, again, from last earnings to this earnings, did it go up significantly? Did it trade sideways? Did it go down? You should consider that. Again, it still doesn't matter because with earnings, it's a coin toss, in my opinion. But this is for the people that are going to play earnings, even though I said don't play them. Just use a little common sense, look at the chart, and that common sense part again. If I'm saying that this company is going to go up XYZ%, that means I'm adding the valuation to this company and saying that it should be worth XYZ. For instance, if we look at $100 billion company and we think that after earnings, it should go up 50%, we're thinking that this company is going to go up 50% as far as market cap. Also, if we're looking at Tesla, like a lot of people are saying that Tesla is going to go to $600. Tesla is currently about $350. If Tesla goes to $600, Tesla would be about what, 2.5, maybe somewhere getting close to 3 trillion. And then you have to say to yourself, does that make any sense? How much money does Tesla make? What does the revenue look like? And then again, I think that will help when we start to pick our options. I know a lot of investors and traders on YouTube and wherever else, they don't add that piece into like picking strikes. But when you pick your strike, just try to make it make sense. And if you're picking a far out strike and it doesn't make sense, just know, I mean, it's a 50-50 at that point. And if you're nervous about it, just play in the money. So for people who are picking, or people tonight that are picking 150, 160, 170, 180 strikes for this stock, in the morning, they're going to wake up to a big loss, regardless of what happens now. The stock is, I mean, the earnings posted, stock is pulling back. It didn't even pull back significantly. But when it comes to options, it is very, very sensitive to what investors and traders think about the stock. So now if you had a 160 call, we know that it's not going to 160 right now, right? Could it go to 160? I don't know, in January, February, March? Sure, it's only $15 more. It could then, but we have to see more. As far as the numbers that we posted, the numbers that were posted today, we don't see it. You know, investors pick which way they want to put their money. It's not going to 160. So I'm saying this to say, when you play options, think about the logic behind it. This also helps when you pick companies that aren't tech companies. For instance, if you trade Delta, what is Delta? DAL. Yep. All right. So if you're trading Delta, this is a good example. Delta has been doing great, right? This is how many months? This is back to the beginning of 2024. So this is just a whole year for Delta. Delta has been doing good. In May, it peaked at 52. August came down to 38, this was a really nice buy point. We can see that was a good support area. We got a few touches there, and there, and then it just took off, right? And this is, I mean, you can count this as a bull flag. This is a strong move up, pullback consolidation, another strong move back out to that upside. So nice pattern that it made. It ran up hot. The thing is, if I don't know, let me see, how much is Delta worth? 41 billion, right? Market. So anytime we talk about market cap, that's how much the company is worth. Delta right now is worth 41 billion. So if someone was charting this out, or they're placing an option, let's say that they bought a leap call for Delta. And a leap, again, for my new people, a leap is basically saying what the price will be in a year or more. Sometimes you can get 2-year leaps, so on and so forth. But a leap, if you get a leap call, you're making a bet that the stock price is going to be higher later, right? If you get a leap put, you're saying that the stock price is going to be lower later. So for a person that doesn't understand how to factor in the market cap to a stock, if you look at Delta and you say, okay, cool, I'm going to buy a 120 call for Delta, and I'm gonna buy a leap for next year. Delta is going to move. Delta has been moving. Delta was higher. Nope. Delta. This is what all-time highs for Delta. Let me see. This is going to help my. Oh, yeah. It looks like all-time highs for Delta, right? So Delta has been doing great, but is Delta going to double? Right. So if Delta doubles, right? So the person who is looking to buy that leap option and set it out until next year, you're saying that Delta, which they're doing great right now, they're worth 41 billion. You're saying they're going to be worth 80 to 100 billion next year. Probably not going to happen, right? Delta is not a tech company. Delta doesn't have a high multiplier when it comes to valuations, and Delta is probably going to be worth. I mean, I could see Delta 41 billion. Delta is probably going to be, I would say, 50 to 60 on a good. If we're talking about they're hitting earnings, they're doing their thing, they're knocking it out the park. You know, I don't know, Trump gives something to airlines or whatever, because I'm seeing Spirit, they're going bankrupt. But yeah, so I just want to nail this home when we're picking these strikes for options. When we're thinking about this, I don't care if you're trading or investing, the common sense part has to kick in when it comes to valuations and when it comes to like what's realistic for the stock. Yvonne?
Can you also talk about the in the money versus out the money, picking that price point and really nailing that home?
Yep. So in the money, out the money. Let me see something. Can I get my option profit calculator? Found it. All right. In the money, out the money. Let's use NVIDIA again. And we're going to pick, let's do it January 17th. All right. So in the money, out the money. So when you're buying options, let me scroll down. This is the current price. Current price is right here, 142.20. So when you're picking options, you have ways that you can set the strike. And again, your strike is just a price that you're saying that the stock is going to go to. Regardless, if you think the stock is going to go up or down, you have to pick a strike. Now, if we're talking in the money is the safest way to set up your option. I don't care which way you think it's going. Calls, puts, in the money is going to be safer. But the thing about safety in the market is that you pay for safety. Why are they pinging? Oh, they're pinging me for work. Set my work phone off. But all right, so you pay for safety in the market, right? So let's say you want to make a bet on NVIDIA. NVIDIA is at 142.20, but let's say you think that NVIDIA is going to 160, right? So you got options. There's a lot of different contracts that you can buy, and all of these different prices are prices for the contract. The only thing you have to do to get the actual price is just move the decimal 2 places over. So if we're looking at this 1365, just move it over. It's $1,300 and $13.65 in dollar value, not $13.65. So if you think that NVIDIA is going to 160, the first thing that people do when they're buying calls, they will go ahead and buy this. So we're going to scroll down and we look at 160 is right here. And when you get out to the middle, you're going to look at the mid, the bid and the ask. The middle, or if you're looking at, it depends on the platform. Sometimes it's called the mark. The mark or the mid is like the middle price, right? You can see this 655, 665, middle is 660. So if you're looking at this, you say, okay, cool. I think NVIDIA is going to go from 140 to 160. I chart it, whatever it works. The contract is $660, right? Cool. That may be affordable for you. Now, is that the safest thing to do? No, because if NVIDIA goes from 142 back down to 135, this contract, that 660, can get blown out of the water, right? This can, let me see, we can actually pick it. So let's pick this contract and we're going to look at a graph. So our option is a January 2025, January 17th, 2025, 160 call. So what this is saying is that we think that NVIDIA, again, in our example, is going from 142 to 160 by January 17th. We're going to pick this option. And let me make sure it's set on profit loss. Cool. All right, this is the profit loss. So this is 142. Let me add some downside to it. We'll do a 130 to the downside just to give us a better chart. All right, cool. So 142 is right here where we're at, right? So NVIDIA actually goes up. Let's say it went up to 160 today. So we bought at 142. We had that 142 call. We spent 660 on it, and it shot up because of earnings. Earnings would have landed us right here at this 160. So 160, you click on it. I'm going to drag this over. That means that we would have spent 660 and we would have made a profit of 643. So we would have went in with 660. We would have came out with 1303. So we would have made almost 100%. We made 97% if NVIDIA actually did go up to 160. Cool. Now, that's almost a $20 pop. That's $18 pop from 142 to 160, right? But let's say NVIDIA went back almost $5. This is $7 right here, right? Click on it. We would have lost $333 just from NVIDIA moving back $7. If it goes up $20, we make 97%. But if it moves back $7, we lose almost half of it, right? So this is something that you have to think about. And the reason that it's happening like this is because the contract that you pick, again, you pay for safety in the market. So the contract that you pick is going to, when it expires, it needs to be 160 plus. You need to have, and you can see how this is skewed. It needs to be all the way up here. If not, this time decay, and you can see that most of this chart is red, right? Most of it is red because time decay is eating up the contract every day you don't make some money, right? The stock, I've seen stocks stay the same exact price from open to close. Well, not stay like intraday, but like it opened at one price and it may close a penny less or 5 cents less or 5 cents more. The contract was still down because time decay. Time decay is decay. It goes against you. It's never positive, right? Now, let's use a different example. So if we think NVIDIA is going to 160 from 142, if it's me, I'm going in the money. So anything in this gray is out of the money. And so when you go out of the money, it can give you more of a pop percentage wise, but it is super risky if it doesn't go your way. So a lot of traders and investors, they try to play out of the money because if you hit, the hit is going to be really nice. But if you miss, again, you can lose it all. And it doesn't have to move back by that much because you have two things going against you, a back pedal, and you also have time decay going against you. When it's moving up, there is no positive to time decay. You just got one thing going for you when it moves up. Now, what you'll have to do is play in the money. So let's say if I wanted to pick in the money is all of this in the white. And again, we're right here in the call section. These are puts. But we're going to go in the money. So in the money is safe. And in the money is what you want to play because it slows time decay down. So when you're underneath the price, this is 142.20. You can see we got 142, 140, 138, so on and so forth. When you're underneath that stock price, again, time decay is automatically slowed. That's why when you look at the price of these, again, this 160 call down here is 660. These in the money, they start at 1365 and they get worse. They get more expensive as you go on. So let's say we just did a 130 call, right? So if it pulls back $12, we're still in the money. If we wanted to do a January 17th 130 call, it costs us $2,148, right? $21.48. So way more expensive than the out of the money call, but let's calculate with the same numbers and look at how the chart looks now, right? You see, instead of having a small sliver and corner of green with a sea of red, you get almost a 50-50. This is about a 60-40 almost. But you have a greater chance of making profit, and you're not losing your money as quick, right? So same example, 142. Let's say it popped up today, boom, from earnings, and it went up to 160. So we click on 160. You're going to make more, of course, because you spent more, right? So you went in with 2148. You're going to come out with 3302. You made a profit of 1154. So you made more, but you had to spend more, right? And this is 53%. So 53.7% is what you made. Again, if you would have got the 160 call, you would have made 97%. But you also have to add in the risk factor. It's way more risky if it would have went that way. Now, let's go the other way. So let's say that it pulled back from 142. We said a $7 pullback, and it pulled back $7, right? Pull back $7 to 135. We look at it, you'll be losing this much right here. So you'll be losing $764. You will walk away with $1384, and you spent $2148. So instead of losing 50-60% of the contract value, you lose only 35%, right? So again, in the money is safer, but it costs more. Out of the money, you can buy more of it and you can make more, but you're running a high risk if it doesn't work. So if I'm playing earnings, which again, NVIDIA had earnings today, if I do anything, I'm going in the money. A lot of people, when they play earnings, they play out of the money. That means if you play earnings out of the money and it doesn't work, you're probably going to lose it all. I've seen contracts, and I'll use me as an example. It was one time we were playing Intel. It was three of us. We were actually on a phone call. We played Intel. Going into Intel's earning, we're up. One of us was up 800. The other person was up 1,300. The other person was up about 470. We were sitting there looking at the earnings, and we said, you know what? We're just going to let it go. We're already up. If it doesn't work, it's not going to chop all of our profits. And if it does chop all of our profits, we can just walk away with what we put in. After the earnings, we walked away with the earnings didn't go our way. The move for the earnings for Intel had already happened. That's why we're up so much. But we thought that it was going to go up even more, which hints back to my example earlier. But we thought it was going to go up even more. We were being greedy. We walked away. I think the highest person had 27%. And the rest of us had, I think we had like 12%. The other person had 0%. So it not only took the profit that we had, but it washed our contract to almost 0. So that's the danger of playing earnings. That's why I say don't play them. You can just keep your eye. Instead of burning up money in the market, you better off just getting the actual cash and setting it on fire. At least you walk away with a lighter. In the market, you burn your whole option up, you walk away with nothing at all, not even a lighter. So in this case, again, I'm going to say it again, do not play earnings. I have to say it's not financial advice. Do what you want. But I'm not playing earnings. I've been burnt too many times. And if some people tomorrow is going to wake up and be upset because of what happened with NVIDIA. All right. Question.
So, a quick question. Okay. Who did make money on like earnings with NVIDIA? Because I was trying to figure it out, right? Like at one point it went to 138. Mm-hmm. So I saw, okay, people who had puts at that made money, but they would have had to sell so quickly. Who knows what will happen tomorrow? But today, after market, they would have had sold when it touched 130 because it moved right back up. So who had the strike prices that actually made money? Because in this situation, NVIDIA didn't actually move that much.
Right. So the only people that probably made money off NVIDIA tomorrow are people who bought puts but were in the money, deep in the money. So the reason why I'm saying it is because, again, it didn't move that much. So if you bought a put, if NVIDIA is at 142, but you bought a 130 put, thinking that it was going to drop all the way down to 130, and it didn't do that, and your contract is set to expire, let's say Friday, or let's say next week, it's set to expire, traders aren't stupid. They're not going to buy that contract. They know that, okay, NVIDIA pulled back, but it didn't pull back to 130. So it's no point of buying that contract. So that means that that put is going to get washed as well. So the people who are going to make money are the people who bought a put that was deep in the money and that had time on it. So you could have bought a, I don't know, 150 put. Remember, puts are flips of calls. So in the money for puts are going to be higher. In the money for calls are going to be lower, right? So the people who bought in the money puts and also have enough time, they're going to see that they might get 20, 30%, but they spent enough. Again, if you bought an in the money put and you got enough time on NVIDIA, those contracts aren't cheap. You might have spent $5,000 on that contract. And if you get 30% of 5,000, you just made $1,500, which still not that bad. But if you have a short expiration, yeah, you may be toast either way. That's why, again, I'm gonna nail it home. I don't play earnest. Does that help, Ty?
Yes, thank you.
No problem. Questions? Any other questions? Cool. Silence is a thumbs up to me. All right. Another thing that can happen with options, which you're going to start to see the personality of the market. We all have to remember the market is not made for us to win. It's to give us a chance to win. There's no guarantees. Now, another thing that happens too with options is that, and this is the part that I really don't like. When you're trading an option for earnings, and let's say when the numbers first post, the stock shoots up, right? So when the stock shoots up, that means the people who bought the puts, their puts are burnt. That's it, right? So the people, as soon as the stock shoot up, the implied volatility of those puts is dead because the stock is already chosen its direction. Now, sometimes a stock would shoot up from earnings, and then when they actually have the conference call about an hour later, the stock shoots back down. Guess what happens? The people who bought calls are now toast too. So there is no winners unless you bought in the money and you bought far out. So if you're ever watching the earnings and you see the stock go up and then go right back down past where it was that day, whatever contract you're holding, if you're playing options, is probably 0-2. They call it a theta burn. So they shoot it up to burn the calls and they shoot it down to burn the puts. I'm sorry, I had that backwards. They shoot it up to burn the puts, down to burn the calls. Nobody wins except the market makers. That, again, sounds unfair. It is. That's why I don't play earnings. I've seen it all. I've tried to play earnings too many times. And if I do play earnings, it's going to be like under $100. I'll throw $75 on a call or $70, $80 on a put. I'll do that. I'm not putting hundreds or thousands on earnings. I'm not. You can be right and still be wrong. The stock can go up and beat earnings and still come down. Or the price can still come down, even though they posted nice earnings beat. So that's another thing that can happen. And that's why I don't play options. I don't play options on earnings. Cool. Just wanted to nail that home for this section because for this session, because I know a lot of people, again, probably played. And they're going to be asking, like I've been already seeing on social media, people are saying, well, they beat all the numbers. Why is it going down? What more do you want? The stock is doing great. If for shareholders, the stock for shareholders is killing it. And for shareholders, it was at 145 today. It pulled back to 130 something. That's nothing. It pulled back. It didn't even pull back $10. So if you're holding shares, that means nothing. But if you're in options, yeah, you're probably hurting right now. And Ty, you said earlier the stock shot down into like the 137, 138 range. Why didn't they sell the options there? Well, here's another limitation. You can't sell options in the extended market. Options can only be bought and sold between 9:30 a.m. and 4 o'clock p.m. Eastern Standard. Some options you have, they can, go to 4:15, but you can't sell options in the extended market. So people who have puts, they can see that it went that low, but you can't sell it until the bell rings tomorrow. Cool. All right. I'm done with my rant. Any stocks y'all want me to take a look at?
Well, Darius, are there any stocks that you think this is a good opportunity to get into?
Good question. I think what Michelle brought up last time, what was it? TL, I'm all backwards. TSLY. There we go. I think this one is still a good one. It's making a bull flag. I think dollar cost averaging, like we talked about last time, still is a good idea for this one because this next payout, Mark and I was looking at this in the Sunday session. The last payout was 60 cents. This next payout could be massive because of this run up from what was the X date on this one? The payout X date was the 31st. So yeah, it caught all of November. When November start? Right here. Yeah. So from end here to up here and probably some more, it caught all of that and it's going to pay all of this out in option premium as far as a dividend. So this next payout is going to be nice. For sure. It's going to be a crazy payout, but I think this one is still a good one. Ty?
So with this, isn't it just shorts? So the share price is based on how the fund shorts Tesla?
I don't think so. I don't think it's about the shorts. I'm talking about the dividends. I'm not sure about the stock price, but I know that
I think we have to double check that because I think I did some research, very preliminary, and I might be wrong, but I think I saw something about that it primarily does shorts. That's its options. So yeah.
Yeah, I'm asking ChatGPT right now. One
Yeah,
second.
ask ChatGPT because there's something unique about how this works.
How
Well,
does
Darius, I also in one of the groups somebody actually brought up this same stock issue, and I'm trying to find the response. They do multi-leg strategies, and they said that they've dealt with this particular. There was another stock as well. They just said be careful of it. They've been burnt because I guess when it does crush, it really crushes. And I'm trying to find the response, and I'll send it to you when I do.
All right, cool. Yeah, I just pulled it up. Let me see. YieldMax is a family of exchange traded funds. Let me see if I can move it. Okay, I can't. I should be able to put this on let me see. I'm about to pull it over so we can all look at it. This is a good topic for discussion because we talked about a really nice option strategy with this one. Just making sure we know how it works before we go. I can't copy. Oh, here we go. Before we go too far in, boom. Okay, I don't know. All right, this works. All right, so it's a family exchange traded funds designed to generate high monthly income by using a strategy centered around covered call options. ETFs typically focus on individual stocks, blah, 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 blah. Covered call, writing, covered call. I know what that is. How do they implement it? Funds hold either the actual stock, synthetic position in the stock, or options. So I think this one's options. They sell call options at or slightly above the current price. Okay, so they're writing covered calls. Okay, cool. The primary goal is maximizing monthly income by selling options. The income comes from premiums, selling call options, dividends, or other returns. Potential outcomes. All right, since the call options premium are collected monthly, strategy. Often selling call. Okay, selling a call option caps the profit. It's really not telling me what I need to know. Income focus, high monthly yields, willing to trade off some capital appreciation for regular cash flow. Investors come. All right, example. All right, it creates a position. It sells call options. Cool. Investors earn monthly based on call premiums minus the fund expenses. So, all right. I tell you what, let's do this. All right, so in this period, let's look at a period where the stock went down and what the dividend was versus the stock going up, right? So from here, what is this? From June to, was it July? Stock was in an uptrend. So what, this is the previous dividend. This is the next one. Okay, so the dividend is higher here, right? So this is a period to where the stock was trading sideways. The dividend is 64 cents or 65 cents. This is a period where the stock went up. The dividend is $1. So this is the period where stock went down. The dividend is 96 cents. So it's less, but let's see what this one is. Okay, this is a period where the stock kind of traded sideways. So it looks like volatility in the stock is, yeah, that's kind of like what we thought, right? Volatility in the stock is creating, again, yeah, the premium for the option is going up, should create a bigger dividend payout from what we're looking at if we're tracking this right. So if we're looking here, this dividend payout is 81 cents. This dividend payout is 68. Yeah, so this is less because again, we need volatility for premiums on options. So there's no volatility here between March and April. It's pretty much chopping sideways. This went down and this one is 69. So we got 68 because it's trading sideways. This one went down and came back up. That's 69. This one is trading sideways. That is 64. That had an uptrend, a major uptrend. That's $1. This one was going what? Oh, I'm looking at the last. Okay, from here to there, that's a major uptrend. It paid $1. So from here to there, this is a downtrend. It looks like, right? Should be less than $1. Yeah, this is less than $1. So yeah, from what we're looking at, we were right. This next payout should be nice. So if the stock is going up, or if the premium on the options is going up, it's going to push the stock up, which makes the dividend more. Did someone come up with a different thesis from how I'm breaking this down? Or Ty or Yvonne? Are we all? I'm just trying to make sure I'm not missing anything.
No, I just read some stuff sort of similar to Yvonne, like be careful with this.
Oh yeah, for sure. You're playing with option premiums. Again, like we just looked at the volatility in options and price. But again, if the stock is going to be going up, Tesla is breaking out of a chain. This could be something to watch for sure. Again, I'm still thinking it is a really good move because Tesla is breaking out of a downward channel. And then, I mean, Elon has been given some privileges, governmental agencies and all the other stuff that Trump is going to allow him to do, which is, I'm for sure Elon's not going to walk away without boosting Tesla stock. It wouldn't be Elon if he didn't. And if Tesla stock is being boosted, the option premium should be going up, which should push this up. It for sure it comes with its risk, because if Tesla pulls back, this should pull back too, which the price will pull back, but then the dividend will be less. So it's still a dividend stock. I don't see a massive blowout. Like I can't see this going from $15 and getting blown out all the way down to 10, like down here. Down here. Because the stock doesn't even move like that. This is what the daily. So it takes, what is this? $13, $13.50 down into the tens. This is what, yeah. So it took a month to move down about $2 or $3. So yeah, I still think trading technical analysis and the rules that we use still apply. Support, resistance, looking at your different indicators. I still think that applies, but this is one that I'm dollar cost averaging in. And again, I need to post it in the Discord. So again, every trade comes with a risk. This one I think is a little, I mean, with the news that we have and the fact that Tesla is finally breaking out, I still think this one is a good one. So this is one I'm paying attention to. Questions? And this is one, again, I'm just dollar cost averaging into. I want to see this next dividend payout. When is it coming? I have to find the date. I need to find it, or maybe it's not announced yet. But yeah, this is one I'm paying attention to. I'm also looking at things that can do well under Trump, which Tesla, Coinbase, banks, as far as Goldman Sachs, JP Morgan and Chase. I like Capital One. I like FICO. So there's a few that I'm looking at, and it's not tech. I think tech is hot. But I've been in bear markets before, and I've traded in bear markets before. And if you're trading tech, it's not too fun unless you're playing puts. But I think that, like, someone give me a tech. What is it? Tech heavy. See, what is it? XLG.
XLK. Okay.
XLK is the heavy, super heavy exposure, right? XLK. Oh, I need to back out some. Maybe I need to go even further. Okay, reset the chart. There we go. Yeah. Ooh. Tech is hot. Yeah, I'm again, crypto, Tesla, just because of Elon and his position. If Elon didn't get that position by Trump, I would throw Tesla in the bag too. But I think we just need a correction in tech. I don't think that tech is done or is out, but I think a 20% correction on the SPY would be nice. And you know, of course, tech stocks are going to feel that too. But I think that that's just healthy because I mean, the SPY normally prints 10 to 12% returns on average. I mean, of course, you got some years it's printing 25, 30%, but can tech have another year like it had last year, right? And if it does, that means we're going to be seeing 4, 5, maybe $6 trillion companies, and I just can't see it. Not under Trump. Trump is again, his whole "Make America Great Again" is more about bringing jobs back to Americans, which means cheap dollars for tech companies. You know, working in, you know, you got Apple in India, Apple in China. They're trying to bring it back here, so they're already talking about the tariffs and things like that, making prices more expensive for consumers. And the companies aren't going to do anything but just put it on their consumers, or sorry, on their customers. But yeah, I think it was a great year for tech, but we have to prepare just in case things flip. And I always remember when I traded the bear market of 21, 22. I know I'm always talking about it like I'm a war veteran to the stock market, but that bear market was pretty bad. But I always remember when I looked and I saw that Warren Buffett was the pretty much the best trader that year, and I'm like, okay, cool. What did he do? He didn't do anything. That's the crazy part. He did nothing, but his portfolio was built so strong. He had a lot of oil, a lot of energy. He had a lot of stocks that people thought were unattractive, but he was collecting dividend payments the whole time. And those stocks, when the market pulls back, they don't pull back that much. Like you're looking at Oxy, if it's $60, it might be $50, right? It's not going to pull back that much. But if you're looking at a tech stock, you're looking at Shopify and it's $60 and it pulls back. Shopify can go from 60 to 20, 25, right? Because of those high valuations. So this new landscape that we're going into, I really don't know how the valuation on companies are going to go. But from what I'm hearing and how Trump is picking people to be in his cabinet, they're going to pretty much go to war with China on tariffs, not like actual war, but trade wars with China. And that's not good for tech stock valuations at all. So with that being said, I'm looking for a pivot. And the good thing is that if those tech stocks do go down, we can buy them for cheap. I think that's why when you look at all the investors that have sold, you got the CEO of Nvidia sold at the top. You got Bezos, he just sold $5 billion in Amazon stock. Zuckerberg has already made his sale. Not Tesla, but I said Tesla. Elon sold a lot of Tesla just to buy Twitter, which I don't know what he's going to do with Twitter, but he's already started to sell. And then he got more of the stock, I guess, in preparation for whatever's about to happen now. Who else sold? You got a lot of CEOs that pretty much sold at the top. And what I've noticed too, oh yeah, you got Buffett. Buffett has sold half of Apple, and been sold, I don't know how much he sold of Bank of America, but sold billions in Bank of America. And I don't think it's a coincidence. I don't think that the hottest time in the market in the last 5 years, 10 years, that all of these billionaires and all of these CEOs are selling around the same time. They have information that we don't. They can make a phone call to each other and say, okay, cool. Your trucking company had 10 trucks last time. How many trucks y'all have this time? Y'all only have 5. Okay, cool. That's not looking good. Let me go do XYZ. We can't make those calls, right? But I think with that being said, that creates an opportunity for us when the market does pull back and tech is not seen as attractive as it has been in the last few years. That's the time to buy it. So when these people are selling these stocks, and again, you got Buffett sitting on $325 billion in cash, that's the good time to get the leaps. If you're ever wondering when's the best time to buy a leap, probably not now, unless you're going with I'm stuttering, the other names that I said before with leaps. If you're buying a leap right now, it's like, again, if somebody is buying a leap on Nvidia, you're saying that Nvidia is going to be 200 next year. You're saying Nvidia is going to be like 5 trillion, 6 trillion, which making 30, again, we saw Amazon makes 150 billion a quarter, not a year, a quarter. So in one quarter, they're making way more than Nvidia makes in a quarter, in a year. But with that being said, yeah, I'm just thinking that we have cycles, just like we have seasons of the year, there are seasons for the market. So we may see a rotation out of tech into the more unattractive names, but that gives us two things. One, you should have bank stocks. Like, this is America, or some people aren't American or in America. Sorry, Todd, but you should own some type of bank stock. Like, if you go to a bank and we all have bank accounts, you should own the bank stock, some kind of financial stock, in my opinion. And I think this could be the time to where they start to pop. I'm hearing JP Morgan and Chase. I keep saying it, but I'm hearing that they could be moving up. So I haven't really got into my research there. I'm just trying to figure out like which way the market is going to go based on Trump and how he's picking his cabinet and his policies. But that's what I think is going to happen. So you're looking at leaps. I would look at undervalued stocks. What's undervalued right now? You're looking at buying shares. What's undervalued? That's the way I would go. I know buying the hot stocks and saying that you made money with XYZ, I know it feels good, but you got to play the long game, right? Not just the game for right now, because a bear market is coming. It's a part of trading. And that's when a lot of people leave trading. Like when I was trading, a lot of people that I started trading with, once we hit that bear market, I was the only one, because they couldn't trade their favorite stocks. Their favorite stocks were down. So they're like, I don't, it's not that fun. The market is kind of drying up. And I'm like, but yeah, this is the time to where you can load up on those names. They didn't want to do it. And then when those names flew off the shelf, right after that, they're like, man, I wish I would have got in 6 months ago. I wish I would have got in 9 months ago. It's like, I said something to you about it, but you didn't want to buy it for cheap. So, yeah. Questions? Comments, concerns, stocks?
I think, like you said, is buy a good company that's undervalued. Make sure it's a good company.
Yep.
And then go out and give some time,
Mm-hmm.
So LJ, you said one of the ones that you would go with probably to 1,000 was like Coinbase. So would you suggest something in that realm for like a leap? And if you were to do that, how would you price action yourself into that?
Yeah, sure. So Coinbase, one thing to note too about Coinbase is extremely volatile, right? So meaning it's going to be shooting up, down, sideways, all of that, because crypto is new, but it's being regulated. So if I'm looking at where to place a leap, let me check the other indicators here. Yeah, this might continue to go. We got space on the stochastics on the monthly. The pullback is coming. So I would wait for a pullback to set my leap. The reason why I would wait for a pullback is because the stock has already ran up significantly from this blue line at the bottom at about 150, 140. So it pretty much doubled from when it hit this bottom. And everything that goes up must come down. Even if it, I mean, this could stretch up from 320 to about 340, 350, could get up that high, but I still want it to come down. If it comes down, then I'll be more likely to get a leap, but it needs to pull back. So when I'm looking at my technical indicators here, the RSI is extremely hot at 72, and we can see once it breaks the 70s, it peaks, but then it has a sharp sell-off. So we got above 70 in this green area, sharp sell-off, above, sharp sell-off, and it's getting above, sharp sell-off at some point. I'm looking at sub 300, 280, 260 would be where I would go long at. And if
You
I'm
mean wait for
right,
wait for the price to go to 280?
yeah, 280, 260 on a pullback is what I would want. We
But
don't
I've
get
been
everything.
waiting for that. I've been waiting for that pullback. It hasn't happened.
Yeah, Bitcoin is marching up, but I still think that Bitcoin is going to pull back too at some point. It's hot right now. Yeah, you know, it's in the 90s. I think it's going to go. It's going to finally touch 100 or go into the hundreds.
Sean said 108 in the Discord today. 108.
Yeah, I think Bitcoin can get into the hundreds for sure. But I do think we still can see a nice sizable pullback after it go into the hundreds. Again, anything that goes up has to
It
pull
was
back.
just at 285, and I was waiting for 260. And I think that my mistake was I should have DCA'd at that point. It was just at 285.
Yep. DCA will save you, especially Utah with shares. If you're strictly shares, dollar cost averaging, just buying as it go down the steps, even if again you're buying 1, 2, 5, 10, whatever at a time.
I find that I keep trying to find a lower, and I can't get it. Right, like 530, 540 meta, 540 is the lowest, and it just touches there. It doesn't stay there for long.
Yep. It touches it and then goes back up. The reason you know why that's happening, a lot of people are buying at that price. As soon as it touches it, they're buying up all the shares. But yeah, if I'm looking at Coinbase again, sub 300 would be nice. It's at 320. Again, it can continue to march up, but I think just patience is one of the, is what it will take to get in. And I mean, depending on how many elite contracts you're going to buy, if you're going to buy multiple leaps, then I mean, you could DCA on leaps. You could get a leap today and then hold it, and if it goes up, you win. If it pulls back, you can just keep buying down the steps. Like, do I think that Coinbase is ever going to go back into the 100s? Probably not. I can't see that happening. And then when we look at it from a pattern perspective, this is an inverted head and shoulders. An inverted head and shoulders, I always say, is one of the most successful patterns at about 85%. Shoulder, head, shoulder, and it ends where it started. The breakout could be right here at about 375. And we see that it had a wick that shot it all the way up to what, 340 something, and then it pulled back. It pulled back right into the zone, into this area. But yeah, so we could just be bouncing around. Oh, I said right here. I'm looking at the wrong candles. That's why. There we go. So it's sitting right here. Let me put I knew something was wrong. I said right here, and I'm like, wait a minute, that's 260. If it was right there, then it's leap time. But yeah, it's here. We can see that we have resistance there, so it kind of stagnated. Again, Sub 300s would be nice. It's only $20 above it, but it also could go up and touch that. But at some point, it's going to pull back. And again, depending on your strategy, if you're going to dollar cost average, you can get a leap now. Set it for, I don't know, 400. You can get a 400, 450 leap that expires next summer. And then you can just dollar cost average. If it goes down, buy on the significant pullbacks. And then once it goes up, you can roll, which would be your form of trimming, or you can just wait until you're about, I don't know how long you would set the contract out, but you can wait until you're about 2 months, 3 months out and figure out if you're going to take profit or not. But crypto is definitely becoming more regulated. The government is getting involved. And again, like I said, I think Coinbase is going to be $1,000 stock. It was
What
just
about MicroStrategy?
MicroStrategy, another $1,000 stock. What is it? MSTR?
Keeps going up. Gift that keeps giving.
Yep. It is going up. It is moving with Bitcoin. Tied right into Bitcoin. It consolidated. Crazy strong move up. I mean, yeah, indicators are maxed out, but that's the stochastics. That's the stochastic can go all the way up to 100, even though it's at 73. So we could see some high numbers. Right now, it's already at 83 on the RSI on the month. So I know if we go, let me see. Yeah, 87 on the week. Stochastics is maxed out. Yeah, again, anything that goes up has to come down. You just have to be patient. So MicroStrategy, another, again, $1,000 stock. This one could be about 1,200 in my opinion.
What's a good buy point for MicroStrategy?
I would say 400, 350 to 400 is my opinion.
So
You said what now?
wait for the pullback?
Yep, just anytime something is running, like they say, some tigers are better left wild. Just let it run. You don't, because it'll be just your luck. You go ahead and hop in, you buy an option, you buy shares, and then it pull back then. That's the worst time. You're like, I knew it. I should have waited. So yeah, I would wait for a pullback again. These can run a little bit more. So, just hold on to your seats. But when we have a correction, just make sure you're like, okay, I'm ready. Whatever that correction is, we have a nice pullback to where it's been pulling back for a minute. You start to see it consolidate. Then you go in, because that's what just happened here. We had consolidation. It's consolidated from March to September. 6 months of consolidation here, and then it popped out. So consolidation again, once it starts to consolidate, then that's when I would check the technicals, and then see what's the next move. So patience plays a part in all of this. Patience. Cool. Any other stocks y'all want me to look at? Oh,
LJ, real quick, while you on that, do you tend to at any time, throw a couple of, 50, $100 in there and see if you play a put on something like that, if you know it's gonna come down, or like maybe take 2 months out on a put or something? Do you try any of those?
Nah. Nope.
No.
The reason being is because sometimes, so we have something in the market called a short squeeze, right? And you can trigger a short squeeze by waiting for a stock to come down, and you keep adding puts up under it. And a lot of people see that it's up. So a lot of people are already buying puts on this, but it's like adding fuel to the fire. The puts are literally holding the stock up. You want to, if you're going to play a put, you want to catch the trend to the downside. Let it break to the downside and start to flow, and then place your put. Yeah. Because while it's raging up, and you're like, okay, cool, this has to come down, but you don't know when, and you don't know by how much, and you have a date on your contract, right? It's going to be expiring at some point. So that's why I don't play puts on something that's running like this. Like, I'll play puts on something that has ran up for a while. I see it starting to weaken this trend. It has a couple days to where it's trading sideways. I'll play a put on that, but a put on something that just went up 10%, nah. I'll sit on the sideline.
Gotcha.
Good question. I used to do that, but I'm talking from experience now. I lost too much money trying to do that when I first started trading, and it didn't work out. Go for the layups. Don't take the
Yeah.
3-pointers.
Got it.
Ooh. Questions? Aaron, what's up?
Grab the spot for me.
Yeah, I'm ready to get to work. All right, what you need?
What is look? It's still playing that tricky game. What did it close at? It closed at 590. It's dropping now.
Yeah, it has a, what is this? Yeah, it's only up 20 cents on the day. Yeah, up 20 cents on the day. It went down to what 584, came back up. Yeah, it's fighting its sleep. It wants to go down. Let's see what it looks like in the aftermarket.
I think it's down $1 or something in the aftermarket.
Yeah, dollar and some change at 588.51, unless it's down even more in extended hours. Yeah, it looks like for it to actually drop, because it has a little gap in this area that can send it down to about 575, 570. I'm sorry, 577 to 575, but it needs to break this 583, 584 line. It's tested it a few times, but it never broke. And every time it tested, it gets bought up. So it test bought, test bought, test bought. If it breaks this, then it's going to drop. Tomorrow's what, Thursday?
Yeah.
Last Friday was a bloodbath. We could potentially have another bloodbath this Friday. Let me see. We had NVIDIA. Let me see. Where's NVIDIA at right now? Look on my phone. Yeah, NVIDIA is holding up to, well, a little bit. And NVIDIA is making a head and shoulders. NVIDIA is good until it breaks that 139.50 range. If NVIDIA holds above 139.50, it can consolidate. And NVIDIA is what's holding the market up. So for right now, the SPY, the number to beat is 583 to 584. If it breaks that, it can drop down into the 570s. And looking at the chart, yeah, it wants to go down. It's just been a good year, and people are holding it up. People believe in it. So every time they're buying every dip pretty much. So it drops down, they buy. It drops down, they buy. But it's losing buying pressure for sure.
Appreciate it.
No problem. Any other questions before we head out? We're a little, I know I started late, so I want to stay a little bit over, but it's 9:30. But yeah, any other questions? Let me stop the recording.